Now, the McKelvey rule, which has a track record that's equally perfect, that's been triggered in 65% of states, the highest since June 2008. So the highest since the great financial crisis. What is happening?
We're definitely hitting what we would consider to be critical mass. For the Sahm Rule, which is a half point increase off the prior 12-month low unemployment rate, that's what you just quoted, 37% of the states. Importantly, California and Texas are among them, the highest population states, the most populous states that employ the most people. You know, the most recent data that we saw showed that there were about 5.3 million Americans actively looking for full-time work.
Danielle DiMartino Booth returns to the show. She is a CEO of QI Research. We'll be talking about her latest findings regarding the labor market. Things have gotten a lot worse than a few months ago, and we're going to find out exactly what's going to happen next to the labor market, jobs, and the economy and markets, and what the Fed's going to do with all this information. This episode is sponsored by NordVPN. Danielle, welcome back to the show.
It is great to be back with you, David. How are you today?
I'm doing well. According to your work, the economy isn't doing well. Let's talk about that. You wrote in a report recently, everywhere you go, anyone who's recognized you has asked you, where's that recession? Because you've been calling for a recession, right? Your call was to backdate the recession. But according to this report that you published, it seems we've landed on a recession April 24th, as in 1 week ago. That's very specific. What happened?
So you're quoting a report that came out a few weeks ago, and the reason that I cited April 24th is that is when we learned that the Bureau of Labor Statistics, instead of north of 500,000 jobs created in the third quarter of 2023, which ended September the 30th, we now know that the economy lost 200,000 jobs instead. So a major swing. A lot of it had to do with this birth-death model that we've been talking about for some time, and the dangers of imputing job creation. That word imputation means modeling it, but the dangers of imputing job creation when you have the bankruptcy cycle picking up as quickly as it has. And lo and behold, when they got the final data directly from employers, they found out again. There wasn't any 540,000 jobs created in the 3 months ended September the 30th, 2023. Instead, 200,000 jobs were lost. So people no longer call me that crazy lady who said recession started in October 2023. Now, at least the data back up what I'm saying. So it's nice. It's nice to be released from the insane asylum, David.
Oh, well, you should walk around with the data on your forehead next time you're at the airport. Okay, Danielle, you also said that the data here is a little more comprehensive than the non-farm payrolls data. Can you elaborate on that?
So again, the birth-death model is just one of the components that goes into the numbers that are reported every non-farm payroll Friday. Well, that once a month, it's like the Super Bowl for investors. That is based on a survey of 700,000 participants. And again, what we get out of that is sometimes the first blush take, you only get like a 40%, 39%, 38% response rate to that survey. So your source, your pool is even smaller. What the BLS reported actually comes from the Census Bureau. And once a quarter, the Census Bureau legally requires every employer in America, so call it north of 1.6 million employers, to report what their headcounts are. So not what you think they are, but what they are. So this is just hard data that flows into the Department of Labor from the Census Bureau and tells you how many Americans are employed. You compare that against the survey and you get the truth. They report the revision. And thank God I talk so loud, because at least I get the word out. Otherwise, it's not as if you've got a reporter on the White House lawn saying, gee, economy went into recession in the third quarter. That ain't going to happen either.
Well, speaking of the non-farm payrolls data, April's number came in really weak, well, much weaker than March. Perhaps this is just a monthly variation, or are we seeing a larger trend here? I mean, April was 175,000 jobs added. March's number was 315,000. That's a pretty big, difference.
Yeah, it's a pretty big jump. And again, we've seen these revisions continue to take down initially reported data month after month after month, really without a pause. more interestingly than the 175,000 jobs that still got a plus sign in front of it, you had the unemployment rate unexpectedly move up from 3.8% to 3.9%. And, David, why could this be the beginning of a trend as opposed to kind of a one-off, an aberration, if you will? Well, what we've seen just this year, now we've got Red Lobster. We can add that to the list of casualties. But what we've seen this year is quite a few liquidations. So it's not that companies are announcing that they're going to be restructuring and come out at the other end. That's your best case scenario, as was the case with Jo-Ann Fabrics, right? Not all the stores were closed. A lot of the jobs were saved. That's not been the case with Rue 21 or 99-cent only stores or so many others that have shuttered in 2024. And what does that mean? It means that once you close, you got 60 to 90 days before these people show up in initial unemployment claims, and they're showing up in the jobless rates. And that's why we know that this is gaining traction such that April was not a one-off.
Before we continue, here's a word from our sponsor today, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. I like to know what the Fed's going to do about this. On the one hand, the unemployment rate has been slowly and steadily ticking up. It's now at 3.9% was the latest reading. On the other hand, the inflation rate continues to stay above 3%. So at what point are they going to look at this data that we're talking about right now and say, maybe there's an issue, maybe we should cut rates, despite inflation still remaining sticky?
So it sounds like, there's something that's positively frightening about the ubiquity, the sheer blanket consensus with Fed officials right now. I mean, they really are not disagreeing. And maybe Austin Goolsby's, tied up in a basement somewhere because we haven't heard from him. He's considered the most dovish of them all. But the person who speaks most closely for Jay Powell is Christopher Waller. He's on the board of governors. He said, maybe we want 3 to 5 more months of inflation data to prove to us that it is convincingly coming down to the 2% target. David, you're asking me what could throw off the potential for not even having the first rate cut come until after the US election. Well, that's when we go back to the unemployment rate. And that is what Jay Powell basically said at the podium. If he sees any unexpected deterioration, I think I'm even using the words that Jay Powell used in the labor market data, then we can expect the Fed to get a move on earlier. Now, before the June FOMC meeting, we've got one more payroll report, and then we'll have another before the July FOMC meeting and 2 more before the September FOMC. To me, that's a lot of runway, given, again, the rapidity with which we're seeing layoffs. Before we started recording, I said, David, hold on, I want to get a data point in front of me. I wanted to compare where layoffs landed in May of 2023. So that was about 417,000 that were reported through the end of the month of May. By the time we get to the month of May, we're already almost at 500,000 through May of 2024. So the pace of layoffs is faster. So I think the risk here for Fed officials is that we do indeed see the unemployment rate tick up from 3.9%, pierce 4%. It's been below 4% for the longest span of time in 50 years. But I think that the risk here is like what we saw in 2008. There's an acceleration of the increase in the unemployment rate.
Wait a minute. I don't think Jerome Powell's on the same page as you. Let's evaluate the statement from a few weeks ago. Press conference May 1st, Chair Powell. So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You see it more evidence of that today in the JOLTS report. As you know, it's still higher pre-pandemic, but it has been coming down both in the Indeed report and the JOLTS report. Is he right?
He's right. And he actually, in that same answer, went on to cite the Conference Board data that shows that Americans are finding it harder to get a new job. If they lose their job, it's the hardest it's been since 2011. He also cited that. And that was fairly unorthodox for a Fed chair. You're supposed to quote official data, comma, official data, comma, and more official data. And instead, he's off quoting the Conference Board and Indeed.com. So that was a little bit off the reservation for him, and it shows that he's paying attention to alternative data sources. Good for him. But we'll see what happens. In subsequent data, we've seen echoes of what we heard from the Conference Board, whether it's University of Michigan. Indeed came out with its wage growth tracker. 40 of the 47 job opening categories that Indeed publishes on have declining job openings, and Indeed is of the mind that we're almost back at pre-pandemic levels of job openings. That's a full reversal for the labor market. And again, at some point, it's going to continue to show up in the official data. I know that the current administration would prefer that it never show up, but time may catch up, even with this administration.
Higher rates for longer. Let's talk about the effects of that on the economy. I want to talk about also your work, where you talked about the Sahm Rule and the McKelvey Rule. So we'll come back to that. So here's a report from Fitch dated February 16th of this year. Fitch Ratings expects banks' asset quality metrics to deteriorate for certain U.S. multifamily loans as borrowers will face elevated risks from higher refinancing rates and valuation pressures as loans mature over the next few years. Well, we've talked about this before, and you've done research on refinancing risk. How significant is this risk even today? Rates have stayed higher for 5 months now, and the housing market hasn't blown up yet.
Well, actually, it's been 10 months since the Fed last raised interest rates, so double that 5 months. And we're starting to hear, right, from the Starwoods of the world, hey, we're running low on cash. We're starting to see a real material pickup in transaction volumes. That's exactly what they were trying to avoid last year, David. They were like, as long as you don't sell it, we don't know what the price actually is. It was all about extend and pretend and the avoidance of price discovery. That seems to have turned. And I think that that's why there's a little bit more panic, because it looks like now we're going to go from unrealized losses to realized losses. And the difference between that is day and night between those two. So I think that 2024 will be quite different than 2023. Instead of talking about, gee, there's this theoretical train wreck in commercial real estate, I think we're actually going to get to see what it looks like.
So this came in from CNBC just today. Sales of previously owned homes fell 1.9% in April from March to 4.14 million units on a seasonally adjusted annualized basis, according to the National Association of Realtors. Sales were also down from April 2023, off 1.9% from last year. Slight cool down in home sales. What is going on there?
It's a sector that I made my bones in housing, so I continue to follow it, monitor it very closely. We had an extraordinary January of announced layoffs. It was just a huge month. April was even worse than that was. But when you're looking at existing home sales data, the thing you have to bear in mind is that you're talking about contracts that were agreed to January, February, March that close in April. So you really are looking in a rearview mirror. But what you're looking at is the beginning of job losses. And there is something that my good friend Ivy Zellman, who's kind of the housing guru out there, she always reminds me, Danielle, there's something out there that can trump high mortgage rates or low mortgage rates. And she said, and that's the unemployment rate. And so once job losses kick in, that is the one factor that is going to supersede whatever it is, wherever borrowing costs happen to be.
I think this next line kind of supports what you're saying. Sales of homes priced below $100,000 fell 7.1% year over year, while sales of those priced over a million jumped 40%. So the rich are doing fine.
It is the have and the haves and the have-nots, right? And you know there's I don't mean to be insensitive and joke about this, but when you look at a company called Lightcast, they've been producing weekly data on job openings since January of 2020. And we saw something really extraordinary in the week ended May 15th. David, do you remember the quiet resignation and quiet quitting and workers demanding really hot, big, huge pay raises? In the week ended May 14th of this year, 2024, we saw job postings for individuals with quote unquote minimal education. So the least skilled workers. We saw those job postings down nearly 18%, and importantly, lower compared to January 2020 than the overall job market. That tells you that those sales of homes that are priced at less than 100,000, you're starting to cut off the oxygen. These are the people who are losing their jobs, unlike in prior years when you couldn't get, let's say, a home health care worker or somebody to clear tables at a restaurant. Those jobs were the hardest to come by. That's been flipped on its head. And that is kind of what we call a plain vanilla recession.
Okay, so here's some interesting data that you put together. So the Sahm Rule is triggered when the 3-month average or moving average of the unemployment rate is 0.5% off its prior 12-month low. In prior cycles, when the Sahm Rule is triggered, it means a recession is here. So that's just for context for the viewers. You wrote that the Sahm Rule is flashing red in 37% of states. Now, the McKelvey Rule, which has a track record that's equally perfect, that's been triggered in 65% of states, the highest since June 2008. So the highest since the great financial crisis. What is happening, and which states are seeing the highest concentration of flashing indicators?
So we're definitely hitting what we would consider to be critical mass. For the Sahm Rule, which is a 0.5 point increase off the prior 12-month low unemployment rate, that's what you just quoted, 37% of the states. Importantly, California and Texas are among them, the highest population states, the most populous states that employ the most people. The most recent data that we saw showed that there are about 5.3 million Americans actively looking for full-time work. David, a fifth of them are in California, a fifth, whereas California's population is only 11% that of the United States. So, the issue with the Sahm Rule being having been triggered in 37% of the states is when we were at that same threshold, we were 5 months into the Great Recession, into the financial crisis. With the McKelvey Rule, which is a 0.3% increase in the unemployment rate, equally efficacious, as you said, equally perfect track record, that's up in 65% of the states. We were 7 months into recession. Guess what that aligns with, David? The crazy lady, and the idea that the recession began in October of 2023.
One of the most commonly seen comments on my videos is, yes, your interviews with Danielle and some others, people have been calling for a recession. Indicators suggest recession's already here. Yet, why are we talking about this? Market's going to new all-time highs every single day. So let's bring it back to those viewers who are concerned. What is the relevance to the market?
The relevance to the market is zero. And I tweeted this out this morning because somebody's like, you've been calling for recession. I'm like, look, until the Federal Reserve acts to lower interest rates, the stock market's not going to wake up and smell the coffee unless it's different this time. Now, it's different this time. Let's examine those 4 words, shall we? Or not. There is also a perfect track record. You do not have a downturn in the stock market until the Fed moves to lower interest rates. Look back at history. It's there for the taking. The S&P 500 goes back to the post-war era. You can see every single time the Fed launches an easing campaign, stocks wake up and they go, wait a minute. We just wanted for the Fed to say that monetary policy was going to get easier. We didn't want them to act on it. If they act on it, for heaven's sake, we really are in recession. And their stocks go. But it doesn't happen until the Fed moves. And if there's one potential criticism for the Fed not acting until after the election, maybe that would be it.
Are we seeing certain sectors of the economy, perhaps more cyclical sectors, getting hit harder than others?
Yeah, right now, in fact, we've seen the quits rate fall in the top 10 highest states where the manufacturing industry contributes the most to their gross state product, with Indiana being the highest intensity. I want to say Indiana's like 28% of its economic output is tied to the manufacturing sector. It's considered to be the most bellwether of states. But the quits rate's been falling there since 2022, April of 2022. That happens to coincide with when ex-auto industrial production turned negative as well. Remember, we were waiting for all those semiconductors, and there were fields and fields of Ford F-150 pickup trucks waiting for those semiconductors. But outside of the auto manufacturing sector, the quits rate, I call it the take this job and shove it rate, job insecurity has been increasing since April of 2022. Same with leisure and hospitality since October of 2022. And that is indeed what we're starting to see. We're starting to hear airlines say, hey, we're not seeing bookings into the summer like we'd expected. We're seeing occupancy declines at hotels, signs that the U.S. consumer is starting to stumble, and that goes along with weakness in particular sectors.
Yeah, so that would translate to maybe weakening in valuations of the leisure and hospitality sectors, air travel sectors, airliners, for example, cruise ships. Maybe we expect these stocks to weaken.
Anything that really depends on consumer discretionary, right? If it's discrete kinds of spending, because Americans are still being squeezed six ways to Sunday when it comes to essentials inflation. You still got, auto insurance up 22%, eggs are up again big time. Things that people absolutely have to buy. And that's why Americans are so mad, David. Let me tell you, they're probably sitting there saying, that lady's gaslighting us again. I get it. I get that essentials inflation is really high. But to your point, that means that Americans are spending more and more on what the food they have to put at the table, the gas they have to put in the gas tank, the roof over their head, and that leaves less left over for them to spend on what they want.
It's summertime though. It's vacation season. Shouldn't we have this? Shouldn't we revisit this conversation again in September when people are back? Wouldn't you anticipate spending to pick up over the next couple of months? Actually, spending did pick up last month. Personal income ticked up slightly, as well as personal outlays. So the PCE actually went up a little bit.
It did, and a lot of that had to do with benefits. You cannot spend a benefit. When it came to those gains on the income side. I don't know. Check out Airbnb stock. You tell me, David. I mean, certain signposts are out there that bookings are certainly not as strong as they were
Sure.
a year ago.
What's interesting to me is that, like I said, the PCE has been ticking up, but so has credit card delinquencies, right? So on the one hand, people are spending more. On the other hand, I don't know if the same people are, forfeiting on their credit card payments. Maybe it's a different cohort, but what's your read on this?
There are a few people on my Twitter feed who are like, if you divide, credit delinquencies in their entirety by disposable personal income, including student loans that don't have to be, they're not penalized until November the 1st, 2024. Everything looks great. And then you look at credit card delinquencies for those who are 20 to 29, 30 to 39 years old, heading into the prime earning years of their life. They're through the roof. And by the way, they're using buy now, pay later on top of that. And that is something that regulators are rightly becoming very concerned about. It doesn't factor into your credit report.
A lot of the indicators that we've been talking about right now are very kind of reminiscent of before 2008, right before the great financial crisis. Labor markets weakening. We've got the housing market starting to roll over, oil going up, stock markets are still hitting new all-time highs. But there was a catalyst back then for everything to come crashing down, right? If you were to, I'm not saying it will happen today, but if you were to create a scenario in which we would get another GFC, what would that catalyst be?
So I think that clearly we've got too much debt on the commercial real estate side. We've already spoken about that. And the canary in the coal mine, and this was pointed out today by one of the credit rating agencies. I can't recall which, I'm sorry, that was Bank of America, excuse me, pointed it out today. We've actually seen now more investment grade debt being downgraded compared to the investment grade debt being upgraded. So they're kind of red flagging that changing of the guards. The first time we've seen this since 2020, when it felt like the world was ending. So, higher for longer is going to affect corporate America's borrowing. And if you start to buckle under the strain of servicing your debts, kind of like Uncle Sam, and we're talking about some pretty big debt issuers. There's a good story out right now about quote unquote fallen angels. If somebody wants to Google that story and see what the exact companies are that are looking like they're very shaky. But again, there's some massive bond issuers that are considered to be investment grade, but increasingly at risk of being downgraded to junk.
This is an interesting chart that you tweeted. How credit scores rose during the pandemic era. So this chart shows that the credit scores have been rising over the last couple of years. So I'll ask you to explain why this happened. And I wonder whether or not this has any impact on rising consumer debt. Presumably, if your credit score increases, you're able to borrow more.
Somebody who decided that they were going to be kind of a wise guy, he tweeted back, if you don't have to make your obligations, you're not going to default on them. And, it was a very succinct rebuttal. But it makes perfect sense, right? You didn't have to pay your mortgage. You didn't have to pay your rent. You didn't have to make your auto payment. You didn't have to pay for your student loan. It's pretty easy for your FICO score to improve, which it did. They call it FICO score inflation when you're not defaulting on debt because you don't have to pay it. But unfortunately, what we're seeing now is repossessions, car repossessions are running as fast as they can manage to repossess individual cars without getting shot. But repossessions are going up. Credit card delinquencies are going up. And why is this, David? Because people, they had access to more credit than they ever had, and they had higher credit scores. But it was because their credit scores were inflated. And now lenders are like, whoa, this is quite the hangover. We're realizing that we actually extended this credit to a subprime borrower and shouldn't have.
So looking ahead, put all this together, what are you expecting to happen to consumers, corporate, well, you talked about corporate debt now, valuations for markets. What's next for us?
I think that really is in the Fed's hands. Individual sectors are going to be increasingly at risk. But by the same token, we're all on Fed watch, and it's pretty apparent that Fed officials know it. So gosh, I wish blackout started like 3 weeks before the FOMC instead of 2 weeks. But until the Federal Reserve starts lowering interest rates, that's going to happen when your unemployment rate goes above 4% and stays above 4%. It's not going to be timed quite yet to sell stocks. Now, do you want to wait until the last minute? Or do you want to take some of your profits off the table and be like the smart money? Well, that's up to you. That's up to you, the investor, and what you're comfortable with. If you want to roll the dice, wait for that big unemployment report to come out.
Let's put it this way. This deterioration in the labor market that we've been talking about, what could reverse that? I mean, a 25 basis point in the Fed funds rate reduction, really? I don't think that'll do it.
And okay, so you're exactly making my point, David. It's
Right.
not going to do diddly squat. Trying to turn a tanker in the Panama Canal ain't easy, and 25 basis points is not going to do it. It's not going to move the needle. As much as there is a lag effect that we're now seeing in commercial real estate, that we're now seeing in corporate credit, as much as there's a lag effect to Fed tightening, there's a lag effect to Fed easing. And so that's going to take a while, and you're going to have a lot more than a quarter percentage point rate cut for that to really make a difference in terms of the consumer and corporations and people who are trying to refinance buildings. It's going to take a while for them to feel that.
Well, you actually told me a couple months ago when I spoke with you in person in Vancouver that you actually would, if given the choice, would prefer rates to stay at 5% versus zero. It would be better for the economy long term if rates weren't zero.
Well, look what we're seeing. We're seeing companies that were existing by virtue solely of the fact that zero interest rate policy allowed them to access the capital markets. And so even though they had broken business models, they were able to stay in business. That does nothing for the long-term health of the economy to keep the deadwood alive. It really does help to either restructure or liquidate and get out, because that's when you get to long-term prosperity. On top of that, David, one of the reasons I brought that up in Toronto when we were speaking in person is because private equity, the private equity is finally being flushed out of the shadows. And we're starting to see these companies that collect huge, massive, fat fees, that some of their investments are actually worth less in the private market than what we're seeing revealed in the public market. Again, it's going to take time to flush them out, but that's what we're starting to see.
Okay, so capital needs to flow back in, and before that, we need lower rates. Is that what you're saying?
We will eventually need lower rates in order to make
Okay.
math work. But making that not work for non-viable business models is still critical for the long-term health of the economy. If we're going to go into recession, let's at least make it count.
I've heard the analysis that in the next recession, it's possible for the Fed funds rate to drop 500 basis points all the way back down to near zero, because historically during recessions, the rate has fallen by the order of close to 500 basis points. Does that make sense to you?
That is history to 2008 in an institution that's been around since 1913. So yes, in the very near term history since December of 2008, when the Fed funds rate was first taken to the zero bound, that has been the case. Listen to Loretta Mester. She's got her last vote coming up at the June FOMC. Soon to be retiring Fed officials tend to be this really strange thing called blatantly honest. She recently said that she saw the new floor for the Fed's funds rates possibly being 3%. So I think we're in a wait and see mode at this point. The so-called dot plot, that ends with a 2 handle, not 0. So, if we're at the precipice of rejecting as failed policy the zero interest rate bound, then so be it. But we're not going to get 500 basis points of easing. That's what that means.
Okay, that's a good point. Final question. You tweeted a chart rather, Gavicar Research. The poor have made no real gain in living standards since 1970. I'll show this tweet here. You've got a red line showing the growing income of the middle class, and then the poor is a blue line, right? And in this scale that's indexed to 100, it doesn't show any improvement in the living standards here. We'll have to dig a bit deeper into how that's calculated. But anyway, what's your read on this?
So, what I was trying to illustrate, beyond some structural impediments, when I refer to that, I'm talking about kind of the downfall of the public school system in America, giving every single child equal opportunities in the classroom to live and experience the American dream. That's a huge component of what's reflected in that chart of the haves and the have-nots. But part of it is also speaking back to the last question you asked me. What is it going to take to flush out bad business models where we're actually going to have to cleanse, if you will, the private equity, the private credit sectors as well? Because Fed policy has fed into making the wealthy wealthier by virtue of having interest rates be at artificially low levels that can keep bad business operators in business and enrich those who have the most money, making the rich richer. But when you do that again, you're cutting the economy off at its knees for everybody to be able to get ahead, because the largest job creation companies, they can't be born into an environment where you're keeping a lot of dead companies, a lot of zombies, so to speak, alive. That's what I want for the policy to succeed in the Fed being higher for longer.
Great analysis today. Thank you. Where can we learn more about you, and tell us what you're working on over there at QI Research these days?
Well, David, we're coming into a big anniversary for QI Research. So I'll give you a code that you can pop up if you'd like for 20% off of an annual subscription to the Daily Feather. I know that you're an avid reader of the Feather. DiMartinoBooth.substack.com. So hopefully you'll celebrate this big QI Research anniversary with me. You know what? I'm not trying to sell you anything. By the same token, you've just enjoyed my Twitter feed, come on my Twitter feed. It's pretty free at DiMartino Booth.
All right. We'll put the links down in the description below. So check that out. Thanks very much. Appreciate it. Always fun.
Take care.
Thank you for watching. Don't forget to like and subscribe.